Hey everyone, hopefully you're having a good day. My name is Andy. My channel is Finding Value. Today we're going to dive into Twitter or X to see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics is generally what I see and what I cover. And let's dive in there and see what people are talking about. At finding_finance, that's where you can find me. And then if you want to join our community, finding-value.com, that's where I go over individual companies. I do trainings on how to pick companies, how to find certain undervalued sectors, what I think is potentially turning and inflecting upwards, which could be investment opportunities. You have the final say in what you want to do. I'm just identifying and sharing what I'm doing on the website and running the community. So, bar chart says, funny chart when Wall Street analysts are the most bullish, run. So, the S&P 500 returns are worse when analysts are most bullish. Looks like they are also human beings and are subject to the increased or positive sentiment that people have. So, returns of the S&P index and then long-term earnings growth rate percent. March 2020, March 2009. This was a really good time to buy in both of those areas, and that was the returns of the S&P 500 index over the next 12 months. So you want to buy basically when everyone has max fear. Max fear and the sentiment is the worst. It is very hard to do when it just feels wrong. When you're a new when you're a new investor, if you're an experienced investor, you kind of know when to load into a stock. It's when everybody is dumping it and it's just getting way, way down there. All of your ratios are going to start to read buy, 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 buy. You'll get an entire alignment where sentiment's bad, ratios are good, the valuations of these companies get very cheap, and that's when you make all of the money in the cycle. You make tons of money buying at these bottoms when everyone is so fearful and liquidating assets. And it just repeats over and over and over. It just keeps going over, which is awesome for those that learn how to invest. If you learn and you're patient, that's where the money goes. USO likely to retest $83 soon. And this is the point and figure chart. Sometimes I use these to identify where strong resistance levels are. And it looks like we are breaking out of that strong resistance, and because we're up around $80 now, moving on up, at least for oil. This is USO, United States Oil Fund, so it might be a little bit different for the fund. We've got another one here. Natural gas inventories rose to biggest surplus since mid 2016. So we've got a big surplus. The weather is really warm. It's really warm here. I think we're topping 60 degrees the past few days and maybe even tomorrow, which isn't helping the demand for natural gas. But yeah, we are probably close to a bottom over the next few months, is my guess, and it'll be a great investment going forward with a bunch of things that are being put in place right now for takeaway capacity and LNG terminals. Jeffrey says X 2020 S&P 500 flatter election year March. So it says, but after 4 months of solid gains, the market is poised for a modest pullback of maybe 3 to 6%. S&P 500 support 4,800 is the old all-time high. This is comparing it to the sitting president running X 2020, sitting president running, and then 2024 is what this looks like compared to some other years. It looks like we have a slowdown in March and April in a lot of these years, and maybe even into May, and then we take off again for these election sitting president running pattern from 1949 to 2023. So this is generally where the slowdown could potentially occur, even though it looks like it's running today at least. Uselink, which is Casper, he says, I never had such a high contrarian urge to buy gold, silver, palladium, and platinum stocks. I had the similar urge in quarter three of 2020 for uranium, though the technicals was a bit better at that point in time. I agree with him. Whenever I look at some of the technicals in gold and silver, I just look at them like it doesn't look like it's ready yet. But for the gold and silver mining companies, but then it's like it's so cheap. And I think some sectors like the silver sector, there's some silver mining companies that don't look too bad, but some of the gold companies just look weird. It doesn't look like they are squeezing up ready to break, like we saw in oil and uranium in September, October, November of 2020. I mean, they just look so good. This time around, you don't have to have a great looking pattern to necessarily go up. It's just it doesn't look as good as it could be. Some silver stocks do look good, and other sectors like gold, it depends. Really depends. Um, Jelly says your first bull market is for learning, your second one is for making money, and your third one is for retirement. How many cycles do you have under your belt? Well, I want to make a comment on that first thing. I lived through half of one cycle. I only saw the back end of the last commodity bull market. I saw it from about 2005 and onward is where I saw the last commodity bull market. And I saw huge runs in natural gas and oil companies at that time. I didn't really see the uranium market. I wasn't really dialed into the uranium space when I was in my 20s. And I saw the silver run from 2008 to 2011. I saw some of the copper stocks. Tech Kaminko was the name that I purchased at $3, sold it at $30. I bought it in 2009, March of 2009. People were just going crazy. But again, guys, I do not have the same knowledge back then as I had today. I mean, it was just sheer luck. But now, oh man, you only need one bull market. You don't need it to make money. You'll retire off of it if you can get this right. You don't even need that much money in it. You need to identify what stocks can give you that oomph going to the upside. And then you want to find maybe, 4 or 5 of them, spread across it, get 4 or 5 in each sector, and that's all you need. I think. And with what I think is potentially coming in the commodity markets, I mean, you only need a couple of sectors to hit it for you. You can turn $5,000, $10,000 in a sector. I personally returned what is that? It was 9,000. It was about $14,000. I think it was somewhere around there. I turned that into what is it now? I don't even know what it is. $400,000 is what I turned one position into, and I've got a bunch of other positions that have done very, very well. You have to get in early when people are fearful, and you can identify that with the stuff that I use, the ratios, the technical analysis, all that stuff. Then you load up, and then you ride it on higher. I'm still doing that. I'm finding sectors that are down, and there's a couple of sectors that are down, like gold and silver, and palladium and platinum. There are opportunities that are way down there. And if you want to start to position in those sectors, I think we've got a long way to run higher. Many hundreds of percents, maybe even thousands of percents are possible in this bull market that is coming. And that's exactly what I share on the website. It's how to get those returns, how to find companies. And this week we're going to go over um, what do share buybacks and some of these higher leverage companies, how do they make so much money and the returns? How does that filter to you? What does it look like? Why are share buybacks such an important thing? And then obviously I'll talk about position sizing and kind of the setups that I look for, the strategies and the setups I look for. Spoiler alert, oil is already pushing $80 during peak refinery maintenance. Cash rolls surging. Spreads roofing and Cushing headed for full-on bizarro world in 3 to 4 weeks. Oil bears have a Texas-sized problem in another month. market's starting to grasp it in terms of the problems in oil. And this is with, refinery maintenance. We're supposed to be building oil here, guys. We're not. We're not really building that much oil. And this is going to be, this is a really good setup in oil. We're just starting to break to the upside today. Hopefully we close strong. I know I'm doing this a little bit before market close, but um, I think we've got a huge opportunity ahead of us in oil and natural gas. Huge. Here's natural gas, and again, I'm showing you the bearish side of how bearish it is in the current moment. Natural gas posts its fourth consecutive red month, its longest losing streak in 4 years. 1, 2, 3, 4, 5, 1, 2, 3, 4. Maybe we have a little bit down month, a couple more months or something like that. We are really cheap. You would have made a lot of money at the bottom of 2020. This is where I purchased all of those assets, was right in here. And then you can see the big move in natural gas. We are going to go through another big upcycle soon. So the whole name of the game of investing, guys, this is what it is. You got to do opposite of everyone else. Go look at sectors that just look like total garbage. You get this A, B, C correction. You get this three wave up move, an A, B, C correction, and then you invest when it's cheap. Find some good companies with a bunch of leverage to natural gas at the bottom, and then ride it higher. The risk isn't as big in the companies because they don't have as much debt anymore as they were in 2020. So some of the risk and some of the volatility to the downside has been taken out, but I still think there's just absolute gobloads of upside potential in a lot of these investments that we can make in some of these companies. The supercore PCE inflation, closely monitored by the Fed, surged in January. This picture does not scream rate cuts. So this is the U.S. supercore PCE deflator month over month, which is surging, which is inflationary. It is surging as much as a lot of the things occurred in 2021. That is crazy. So maybe inflation's coming back. Maybe that's what's driving oil and gold to the upside here. Just a coincidence, what JC did is he took crude oil futures and posted it. He took the TIP divided by IEF, inflation protected securities or treasuries, versus nominal yielding treasuries. And you can see that move up. And then he inverted Apple, and you can see the inversion of Apple moving up. They're all correlated. They're almost all the same. Everything is financialized at this point, guys. If we get this type of inflation, I think it's going to link to crude oil really starting to move to the upside. And probably interest rates will follow. We remain bullish. So this is the S&P divided by the TSX energy index. So this is the energy bull markets. You can see that we've been moving sideways here, and then you can see it really heats up in a lot of these different years coming up here pretty soon. That's 60 to 69, 74 to 81, 99 to 2008, 2009 to 2014, which is this guy down here, and then 2020 to 2024. I think we're going to get a big move up, a big surge, I think is coming in the energy markets. Here's gold, market sniper. He says the next leg for north of 2,200 bucks. You can see that we just broke out here recently with gold ripping to the upside, and the projected move of what he has is somewhere north of $2,200 an ounce. Hopefully that plays out, and hopefully we get a big move in gold. Markets are sniffing around further stimulus to address the evolving banking issues. That is clear illustration of the persistent problem we've been facing, a global synchronized debasement. Although the chart specifically compares gold to various fiat currencies, the same phenomenon holds true for other hard assets. There we are, we're starting to work our way on up here recently in all these different currencies. Gold in euro, Japanese yen, Great Britain, Canadian dollar, CNY, Australian dollar, and US dollar. We're all about to rip to the upside with the global synchronized debasement of currencies. Break wave, he says freight futures AM update, dry bulk's up 9%, Panamax is up 4%, and VLCCs are up 2%. That's nice. We've got, they're dancing together, the 10-year yield and crude oil futures definitely what I notice too is crude moves sometimes first, but most of the time it moves a little bit before the 10-year yield. But here we are moving together, and we'll see what occurs. There are times where crude oil does go up when the 10-year yield goes down, and that's generally later in the bull market. It's like the blow off top, potentially. If you want some low correlation to tech, energy might be a good idea. So, what's low correlation? So, energy is the most decorrelated sector to tech, which is XLE. So, XLE, or the energy sector, is the least correlated to technology stocks, just an FYI. And that's due to inflation and the market conditions. So, inflation drives energy, and then the disinflation, low inflation, low interest rate environment generally drives tech. This guy says this is one of the dumbest things I've ever read about Bitcoin. JP Morgan analysts predict that the Bitcoin price will drop to 42,000 after halving, citing reduced miner rewards and higher production costs. The halving event will reduce Bitcoin miners' rewards from the current 6 to about 3, and this reduction will negatively impact miners' profitability and lead to a higher Bitcoin production cost. JP Morgan analyst led by whatever wrote in a report on Wednesday, the Bitcoin production cost influences its price, with the analyst predicting it to be around 42,000 post halving. Basically, your cost curve. Now, here's something that Andrew's one of my friends, we would go back and forth. If you continue to have and have and have and have, what happens if the cost to produce the coins goes way above the price of Bitcoin? Like what if the price of Bitcoin's at, $20,000 and the cost to mine it is up around, 60 or 100,000 or something? Does that mean the whole network shuts down? Or do they have to transfer a bunch of fees to every transaction? How does that all work? I'd like to know that. Put it in the comment section how that works if you guys know. Not going to go over that one. QQQ, momentum dwindling pending confirmation. I know that we were moving up today, but this person posted it yesterday, and he's looking for a move lower with the relative strength moving on down. We've got once we get out of this 2-year accumulation, everybody will want to buy it. Target's 54, and that's breaking this accumulation zone for Suncor, which is a Canadian oil sands company. Rising oil prices could cause the Federal Reserve to hike rates in the summer. Maria Bartiromo, however you say her name. Rising oil prices could cause the Federal Reserve to hike rates in the summer, says Larry McDonald. We've got the great Martise NASDAQ update. Another beautiful double top 8K target over the next 24 months is what he's got in the Batman pattern of a lifetime with the little eyes down here. Is that going to occur? I don't know. We'll see. We'll see. That's his target there. And that's what I've got for today, guys. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We still have the coupon code LEAP, LEAP. We're in leap year. If you want to use it, go for it. It gets you 50% off the first month in a monthly membership to basically try it out. Or you can get a bigger discount and sign up for the yearly membership and get a lot more off for that yearly membership. So that's what I've got for today. We'll catch you next time. This is Finding Value.